question during this time, simply press star followed by the number 1 on your telephone keypad. If you would like to withdraw, Ms. Gabrielle Rabinovich, please go ahead.
Thank you, Gabriel. Good afternoon, and thank you for joining us. Welcome to PayPal Holdings earnings conference call for the second quarter of 2020. Joining me today on the call are Dan Schulman, our President and CEO, and John Rainey, our Chief Financial Officer and EVP Global Customer Operations. Please note that we are taking this call from separate locations. We appreciate your patience as we adjust to these new logistics. We're providing a slide presentation to accompany our commentary. This conference call is also being webcast, and both the presentation and call are available on the Investor Relations section of our website. We will discuss some non-GAAP measures in talking about our company's performance. You can find the reconciliation of these non-GAAP measures to the most directly comparable GAAP measures in the presentation accompanying this conference call. Management will make forward-looking statements that are based on our current expectations, forecasts, and assumptions, and involve risks and uncertainties. These statements include our guidance for the third quarter and full year, as well as the impact of our acquisitions. Our actual results may differ materially from these statements. You can find more information about risks, uncertainties, and other factors that could affect our results in our most recent annual report on Form 10-K and quarterly reports on Form 10-Q filed with the SEC and available on the Investor Relations section of our website. You should not place undue reliance on any forward-looking statements. All information in this presentation is as of today's date, July 29, 2020. We expressly disclaim any obligation to update this information. With that, let me turn the call over to Dan.
Thanks, Gabrielle, and thanks everyone for joining us on today's call. And I hope that all of you are safe and well. I'm pleased to say that PayPal just had its strongest quarter since becoming an independent public company 5 years ago. Simply put, our business has never been more relevant and important than it is today. In the midst of the scene substantial macro changes that we believe will have a lasting positive impact on our business. The world has accelerated from physical to digital across multiple industries, including retail. Merchants are embracing a digital-first strategy, and these trends have fueled the rapid rise of digital payments. These are durable and meaningful tailwinds, and we are fortunate to have the scale, scope of services, and brand reputation to capture the benefits of these trends and extend them to our customers. Consumer behavior has shifted in a discontinuous manner, and PayPal clearly has a unique opportunity to accelerate its path to becoming an everyday essential service. The strength that we saw across our business in April continued to gain momentum throughout Q2. Our transactions grew by 26% to 3.7 billion, consistently rivaling the volumes that we usually experience during the 5 days between Thanksgiving and Cyber Monday. Transactions on our PayPal checkout experiences remained especially strong, growing almost 40% year over year. TPV grew at 30% on an FX neutral basis, with a record $222 billion of processed volume in Q2. TPV accelerated throughout the quarter, and June marked our highest growth rate since our separation from eBay. We added a record 21.3 million new customers in the quarter, increasing nearly 140% year over year. To put this in perspective, this quarter's net new actives were greater than our total net new actives in 2016. Nearly 1.7 million merchants signed up for PayPal in Q2, and Honey net new actives were nearly 3 times that of Q1. Importantly, we continue to see increased levels of engagement. Our 10-day adoption rate for our newest cohorts grew by 20 to 30% over last year. And across our PayPal base, our daily active users have accelerated by almost 40% from last year. We ended Q2 with 346 million active accounts and with over 26 million merchant accounts. Given our momentum, I believe that we will add approximately 70 million net new actives this year. These trends drove record financial performance in the quarter. Revenues grew by 25% on an FX neutral basis to $5.26 billion, accelerating after our strong 20% revenue growth in April. This is the first time our quarterly revenues have exceeded $5 billion. Due to the strength of our PayPal branded transactions, our non-GAAP operating margin increased by a record 500 basis points to 28% this quarter. As a result, our non-GAAP EPS grew by 49% year over year to $1.07. And all of this led to record free cash flow of $2.2 billion in the quarter, up 112%. In the first half of 2020, the penetration of e-commerce as a percentage of retail sales outpaced prior external forecasts by an astonishing 3 to 5 years. In this environment, the demand for our products and services has dramatically increased and unleashed multiple opportunities. We are focused on several key initiatives to fully leverage this unique moment in time. First and foremost is our push to accelerate in-store contactless payments. Both consumers and merchants are rapidly moving towards digital payments across their online and offline experiences. This is an existential issue for merchants who realize that reopening their retail stores depends on touchless forms of payments to keep both their employees and customers safe and healthy. There are numerous market research studies highlighting that consumers no longer want to handle cash or other forms of payments that require any physical touch at checkout. We are significantly investing to accelerate our presence in all forms of omni-channel commerce, from point of sale in store to buy online and pick up in store, order ahead, pay at table, and home delivery. In addition to iZettle, contactless cards, and integration with both Google Pay and Samsung Pay, we announced that our QR code functionality is now available across 28 countries for small and micro merchants. And we are working with leading retailers throughout the US and Europe to aggressively roll out an integrated point-of-sale QR solution beginning this quarter, with expansion planned throughout the year. For instance, we are working with CVS Pharmacy to enable PayPal and Venmo QR codes for payment at their cash registers, and we expect a full national rollout to their 8,200 standalone store locations by the end of the year. Our merchants and our consumers want us to expand in store, and we will not let this opportunity pass us by. The rollout of QR functionality will also accelerate our Venmo monetization efforts. Venmo also had a very strong Q2, with record NNAs and an active base that now exceeds 60 million consumers. In Q2, Venmo grew its TPV by 52% to almost $37 billion. Revenues continue to outperform our expectations, with year-over-year growth rates of greater than 60% during the first 3 weeks of July. We are seeing substantial increases in the use of Venmo as the pandemic continues on, as more consumers turn to Venmo to live their financial lives, including adoption of direct deposit functionality, and later this year, the Venmo credit card. We recently introduced business profiles, a unique new way for consumers and merchants to connect on Venmo and exchange goods and services with the same protections enjoyed by PayPal customers. These initiatives will drive significant additional value to Venmo users and consequently drive new vectors of monetization. We are also expanding functionality beyond omni-checkout in both our PayPal and Venmo digital wallets. We will roll out additional services over the next several quarters, including bill pay, subscriptions and rewards management, shopping tools from Honey, and new forms of credit and budgeting tools, to name just a few. Our goal is to meaningfully expand the range of services provided inside our wallets. We believe these and other actions will bring us closer to having a full set of capabilities for consumers to use on a daily basis. Our rapidly increasing scale makes us highly relevant to merchants of all sizes and provides us with large sets of data to offer customized services and solutions. Over the last few years, we have developed, acquired, and grown a strong and diverse portfolio of capabilities that address many of the current needs of our merchants. These range from end-to-end digital payment processing to sophisticated risk management and shopping tools that ultimately help to drive increased sales and engagement so that our merchants can thrive in the era of digital commerce. And it's the combination of these assets together that provides unique competitive differentiation for our enterprise merchants, channel partners, and small business customers. Providing merchants with a comprehensive, consistent, simple, and unified experience remains a guiding principle for us as we continue to add new products and services. And as is evident by the number of merchants signing up for PayPal, our integrated platform has never been more relevant or needed. We continue to extend our platform capabilities around the world. We recently entered into an important commercial relationship with Gojek, a leader in mobile commerce in Southeast Asia with 170 million users. In Brazil and Mexico, PayPal is available as a payment option in the Mercado Pago online checkout for shoppers. And PayPal is now available for cross-border transactions on Mercado Libre. And we continue to build our team and capabilities in China as we integrate with our GoPay platform, partner with China UnionPay, and other leading Chinese players. COVID-19 was not the only set of issues we addressed this quarter. As all of you know, we are witnessing an outpouring of emotion and determination to address centuries of systemic racism. In June, we announced a comprehensive $530 million commitment to support Black and minority businesses and to fight economic inequality. We felt it was necessary to not just condemn racism, but to commit to doing the necessary work over the long term to help create a more socially just society. Even as we navigate these unprecedented times as a business, we have the ability to act in a way that clearly represents our values, especially around inclusion. We still have lots of work to do, but we are fully committed to a future where all people can live with dignity and respect. This is also a special quarter for PayPal because it marks our 5th anniversary as an independent, publicly traded company. During that time, we've dramatically expanded our platform capabilities, value proposition, geographic footprint, and our market leadership. However, I believe the next 5 years will bring about even greater opportunities. We have an ambitious vision for PayPal to be a central player in the future of the digital economy. I'm confident we can drive towards that goal. We have a solid track record and an unwavering dedication to delivering essential, differentiated, and best-in-class services to merchants and consumers. This is our time, and we intend to seize the moment. Our products and services have never been more important, and we are ready and well-positioned to capture the opportunities that lie ahead of us. And with that, I'll now turn the call over to John. John?
Thanks, Dan. I'd like to start by thanking the entire PayPal team for their efforts to serve our customers and execute on our priorities during these unprecedented times. Since our last earnings call, the encouraging business trends that we've called out have persisted, and we're reporting the strongest quarterly results in our history. As Dan discussed, in the current operating environment, our business has inherent advantages. By many estimates, the pace of e-commerce penetration has accelerated by several years in a single quarter, and there is greater demand for contactless payments than ever before. These shifts play directly to our strengths and will enable us to advance our competitive positioning. At the same time, there is ongoing uncertainty as it relates to both the progression of the coronavirus as well as the state of the macroeconomic environment. We are carefully monitoring the pace of recovery and these interconnected dynamics. This overall level of macro-related uncertainty has resulted in increased complexity in building our forecast. It is with this backdrop that we're updating you today on our business and our outlook for the remainder of the year. Our second quarter performance highlights the benefits of PayPal's diversification and scale and our resulting earnings power. We delivered 25% revenue growth on a currency-neutral basis, 49% growth in non-GAAP earnings per share, and generated $2.2 billion in free cash flow. We did all of this while absorbing ongoing pressure from reduced travel and event spending and lower revenue from our credit products. I'll now provide the details of our financial performance for the quarter and then our expectations for the rest of the year. Revenue in the second quarter increased 25% on a currency-neutral basis to $5.26 billion. Transaction revenue grew 30% on a currency-neutral basis, the strongest growth we've ever reported. Growth accelerated 13 points year over year and 15 points sequentially. Transaction revenue growth was primarily driven by strength across our PayPal checkout experiences, which more than offset the approximately 60% decline we saw within our travel and events volumes. For context, travel and events represented slightly more than 10% of our TPV in the second quarter last year. In addition, cross-border volumes increased 24% in the quarter, which also supported transaction revenue growth. Other value-added services revenue declined 26%. Lower credit revenue in the quarter resulted from a number of factors. These included customer relief actions, fewer merchant loan originations, the lapping of $58 million of interim servicing revenue from Synchrony recognized in Q2 last year, and an approximate $17 million impact from increased expected credit loss provisions related to macroeconomic adjustments. Lower interest income due to lower interest rates globally also contributed to this decline. Revenue from Honey, also part of this line item, only partially offset these headwinds in the quarter. In the second quarter, transaction take rate was 2.23%, and total take rate was 2.37%. Compared to the second quarter last year, these declined 2 basis points and 13 basis points respectively. Transaction take rate increased sequentially, and excluding the effect of person-to-person volumes, increased year over year as well, reflecting strong volume growth from PayPal checkout experiences. Moving to our volume-based expenses. As a rate of TPV, we're reporting record low transaction expense and transaction loss performance. Transaction expense was 83 basis points as a rate of TPV, a decline of 11 basis points versus Q2 last year, primarily due to the funding mix on our platform in the quarter. Transaction loss was 12 basis points, an improvement of 2 basis points year over year, and the fifth consecutive quarter in which we performed in this range. Risk mitigation strategies and risk model enhancements continue to drive this improved loss experience across our platform. Together, transaction expense and transaction loss provided 335 basis points of leverage. At the same time, given current economic forecasts, we increased our macro-related reserves for expected credit losses by $117 million. This flows directly to our income statement, increasing credit losses by $100 million and reducing other value-added services revenue by $17 million. After taxes, this adjustment to our provision represented a 7 cents per share impact to earnings. Entering the quarter, our reserve coverage was 17%. With this additional increase in our reserve, we exited the quarter at 22% coverage. Overall, the combination of our strong revenue and volume-based expense performance resulted in transaction margin dollars increasing 26% to approximately $3 billion. Our transaction margin expanded 179 basis points to 56.6%. 335 basis points of margin expansion from transaction expense and transaction loss was partially offset by 156 basis points of deleverage from loan losses. Non-transaction related expenses increased by 10%, resulting in 326 basis points of leverage. Customer support and operations as a line item contributed more than 40% of this leverage. Excluding the impact of our recent acquisitions, non-transaction related expenses increased 3%, or only 4 cents for every incremental dollar of revenue, once again demonstrating the scalability of our business and our operating discipline. Operating margin for the quarter was 28.2%, improving more than 500 basis points year over year, the highest level of operating margin expansion we've reported in our history. Strength across all parts of our business contributed to this performance. Non-GAAP other income in the quarter declined by $60 million relative to last year, predominantly driven by increased interest expense from a higher debt balance and reduced interest income from lower interest rates. For the second quarter, non-GAAP EPS increased 49% to $1.07. Our earnings performance demonstrates our ability to successfully execute in the face of a more challenging operating environment, as well as the strength and resilience of our platform. Excluding the macro-related charge for expected credit losses, non-GAAP EPS would have increased 59%. We ended the quarter with cash equivalents, and investments of $16.2 billion. In May, we raised $4 billion in long-term debt with a weighted average effective interest rate of 2.26%. We ended the quarter with $9 billion in long-term debt. In addition, we generated $2.2 billion in free cash flow in the quarter, or approximately 42 cents of free cash flow for every dollar of revenue. And year over year, free cash flow grew 112%. We're very well positioned from a balance sheet and liquidity perspective. This solid footing gives us the flexibility to successfully navigate this environment and emerge stronger. We've identified several opportunities to accelerate our long-term growth and advance our leadership position in digital payments. As a result, in the back half of the year, we plan to invest heavily in support of these plans, which I will discuss in more detail shortly. I now want to shift to our expectations for the rest of 2020. With more than half of the year behind us, our strong results and ongoing momentum, as well as the secular tailwinds that have accelerated this year, we are reinstating our full-year guidance. While the timing of the end of the pandemic and the eventual path to economic recovery remain unclear, we have more visibility and confidence in our trajectory for the remainder of 2020. Our updated full-year outlook is a significant raise relative to our prior guidance for revenue, earnings, and free cash flow. For the back half of the year, our overall expectations are that TPV and revenue will perform in line with the second quarter, with 30% volume growth and 25% revenue growth on a currency-neutral basis. We also believe non-GAAP EPS will grow approximately 25% on a spot basis in both Q3 and Q4, based on the strong leverage we're seeing and our investment plans. As a result of these expectations, for the full year, on a currency-neutral basis, we now expect TPV to grow in the high 20s% range and revenue to grow approximately 22%. In addition, for the full year, we now expect to grow non-GAAP EPS in the range of 25%. I'd also like to note that included in this guidance for 25% EPS growth is our expectation that the other income line item will reflect a net expense for the year, given lower interest rates on our corporate cash and the debt we recently raised. Relative to the guidance we provided in January, our updated guidance represents a raise of approximately 3.5 points of growth to revenue and 9 points of growth to earnings. In addition, we now expect to generate more than $5 billion of free cash flow this year, an increase of $1 billion relative to our prior guidance. I'd like to give some context for this improved outlook. The revenue growth we expect reflects continued strong performance in transaction revenue, partially offset by ongoing pressure in our credit products. It also reflects a 1-point headwind to growth from the eBay Managed Payments migration. The rate of growth we're expecting for the year represents a 7-point acceleration from 2019 and is indicative of the elevated and sustained engagement we're seeing across our platform. In addition, we now expect our operating margin to expand by at least 100 basis points relative to our prior guidance that it would have been flat versus last year. Based on the mix of transaction volume and our strong business trends, we expect to continue to show transaction margin expansion throughout the rest of the year. At the same time, included in this guidance and partially offsetting transaction margin expansion are our plans to invest approximately $300 million in the back half of the year to advance our key priorities and accelerate our growth initiatives. We believe that we have a unique opportunity to strengthen our competitive positioning and extend our leadership. We've never been more relevant to our customers around the world, and we're focused on doubling down in several areas to help ensure that we sustain and enhance our strategic advantages. This is quite possibly an inflection point in the growth of e-commerce and digital payments. And as a result, we're electing to invest much of our margin improvement to help ensure our long-term success. We believe that the guidance we're providing today is consistent with the significant advantages from which our business is currently benefiting. Relative to when we last reported earnings nearly 3 months ago, we have more confidence in the sustainability of the elevated e-commerce trends we're seeing. What at first felt like a potentially short-lived phenomenon resulting from initial panic and pantry packing and even stimulus checks has become a much more durable and profound behavioral shift. We've seen the strongest and most encouraging new customer volume and engagement trends in our history. At the same time, given our exposure to travel and live events, we've watched demand in these verticals essentially grind to a halt. Our business has demonstrated its ability to withstand exogenous shocks, and the diversity and scale of our platform is allowing us to outperform even while absorbing meaningful pressures. 3 months ago, the idea that our PayPal branded experiences would enjoy TPV growth for an entire quarter at a level consistent with and only previously seen during high-velocity holiday selling days like Black Friday and Cyber Monday was bold and even somewhat inconceivable, especially in the midst of a global pandemic and the highest levels of unemployment in our lifetime. And while we know more today than we did a few months ago about both the virus and the economy, there continues to be palpable uncertainty. As we sit here today, the concept of normalcy is being redefined and at times feels elusive. What we do know is that this is a pivotal moment in PayPal's history. We believe that we've never been better positioned to realize our ambition for greater relevance, ubiquity, and impact as a global payments leader. We recognize that this is our time to capitalize on our strategic position and financial capacity to serve our customers better and to advance our platform. And we're committed to achieving our full potential. In addition, through this period, we've learned a lot about our organization and its resiliency and what we can accomplish when we're focused on delivering against a defined set of key objectives. We're committed to continuing to support our employees, our customers, and our communities through these challenging times, and to create sustainable long-term value for all of our stakeholders. I'll now turn it over to the operator for questions.
Thank you. At this time, I'd like to remind everyone, in order to ask a question, press star, then the number 1 on your telephone keypad. We ask that participants please limit themselves to 1 question at a time, then queue up again for any further or follow-up questions. Thank you. Your first question will come from the line of Tien-Tsin Huang of JP Morgan. Please go ahead.
Thanks so much. Really terrific results here. Just trying to think about what to ask up front here, but you've got record new ads, volume, engagement numbers, all great. So is there a way to maybe hone in on what changed since April? What's driving the performance? If you had to rank the biggest factors, enough to give you confidence to reinstate guidance and call for sustainability in the third quarter in relation to what we talked about last quarter. Just trying to maybe summarize that if you don't mind.
Yep, sure. I'll take a crack at that. So obviously, our best quarter by far, both on the NNAs and engagement, particularly. Just to give you some color around it, Tien-Tsin, 21.3 million. You knew what April was, but May and June were equally strong in our net new actives, and these are high-quality LTV NNAs that come from our core markets around the world. Merchants were up about 3 times what we typically see. This is really a reflection of industries moving towards digital-first strategies. And we see that continuing. Honey, I talked about being up 3 times Q1. It's got a perfect value proposition for these economics. Obviously had a record NNA quarter. Zoom, which we didn't talk about last time, Zoom, which has a great value proposition. Zoom 600% in Q2 versus. And because of all that, we're continuing to see substantial year-over-year growth, and we believe we'll add about 70 million NNAs, which is at least double what we typically do in a year. On the engagement side, I think it's possibly even better news than the NNA side. We look at 10-day engagement for our new cohorts, like how many of our new cohorts are doing 4 or more engagements within the first 10 days. And that's up even further than what we saw in April. That's now up 20 to 30% versus previous cohorts. Our daily active user 40% versus last year. And our churn, which is a really important number as we think about NNAs going forward, has also meaningfully declined as well. And so why is all of that happening, I think? And, obviously volumes I talked about very quickly, but I think what's important on the volumes is that, April was our low, June was our high in terms of volume growth. So you can see the acceleration. That, by the way, is with travel and ticketing events down 6%. And outside that, Braintree is experiencing some of its best growth in a long, long time. So, volume continues to accelerate. But the reason for all of this, from my perspective, is the following. First of all, we see a tremendous amount of new cohorts coming in that have never used e-commerce before. That's mostly Silver Tech. We talked about that. That fastest growing segment. Also seeing a huge amount of new use cases. People are giving in different ways. They're basically doing P2M workouts that are streaming. We're seeing new industries come onto digital because the digital economy is everything right now. And so you're seeing healthcare, education, fitness, restaurants, entertainment, all swinging dramatically to online. You're seeing brands now for the first time sell directly to consumers online. And vertical it's very hard for a merchant not to have PayPal on there. When they have PayPal, they see a sales lift as a result of that, sometimes up to 50% plus. And by the way, our placement in merchants now is improving as well as they see how critical PayPal is for their sales, and then our brand reputation, the experiences that we're giving, new products and services that we have right now, including QR codes coming out. All of that kind of gives us this confidence, and also that the results we're seeing will be quite resilient as we look forward, which is why we felt comfortable reinstating guidance for the year. John, do you want to maybe add a little bit to that?
Yeah, so I just had one small comment, Tien-Tsin. I think for everyone, the sustainability of these elevated levels of e-commerce and digital payment trends is the big question. And I think one of the things that gives us a little more conviction is, we're 3 months further along than we were on the last call, is just seeing the elevated levels of these trends, and particularly in regions that have relaxed some of their shelter in place or social distancing measures. And even when consumers are going back to somewhat normal activities like eating out at restaurants or shopping in grocery stores, the level of e-commerce